Is COVID-19 the final nail in the coffin in the death of American malls? Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is managing partner at Equity Velocity Funds, Matt Lasky. Now, Matt is the managing partner at Equity Velocity Funds, which is a boutique real estate private equity firm based in Columbus, Ohio. Now, there he is responsible for deal sourcing, structuring, analysis, and post-acquisition strategic planning. His focus is on value-add and opportunistic healthcare and retail assets, and Equity's current portfolio consists of approximately $400 to $500 million of assets under management. Now, here's what you're going to learn in our conversation with Matt. The biggest question that we cover, the biggest topic of today's interview is COVID-19 the final nail in the coffin in the death of American malls, or at least as we know them today? And so you'll have to wait for that one. It's in the middle of the show, and it's a phenomenal answer that Matt outlines for us. So in addition to that, we're going to learn about how Matt got his start as a broker with Marcus & Millichap and the reasons why he feels that this is a great stepping stone for those looking to get into the commercial real estate investment space. You're going to learn what his role entails as a managing partner at Equity.net, along with additional insights on how Equity's unique structure puts responsibility on Matt for both the acquisition and deal sourcing, as well as the day-to-day asset management of all respective deals. You'll learn what his outlook is on the American mall and his professional opinion on how he feels both A, B, and C class assets will fare during these uncertain times. You're going to learn about the various ways that developers are creatively repurposing dark big box spaces on prime located malls and retail centers. You'll learn about the various reasons that he is still very bullish on service-oriented neighborhood retail centers, even given our current challenges associated with the pandemic. You're also going to learn about what strategic moves he and his team are making to best position themselves for the potential distressed opportunities that might come in the aftermath of the pandemic, and much, much more. And so, guys, with that, I'm super excited to get onto the show with Matt. But before we do, I just have a few quick housekeeping items. First and foremost, guys, we recently launched a brand new partnership program called Bring Kevin a Deal. And this is where I will pay you as much as $200,000 for any one mobile home park and or parking lot that you bring to me that I ultimately end up buying, okay? Now, to learn more about this opportunity and to download my deal acquisition criteria guide, you can go to bringkevinadeal.com. Again, that's bringkevinadeal.com. Moving on here. If you love what we're doing here at the Real Estate Investing for Cash Flow podcast, and you haven't done so already, please subscribe to the show. That way you'll be first in line for when the new shows get released. And also, if you love what we're doing, the content, and it brings value to you in your business, please take a moment to leave a rating and review on iTunes. It really helps us attract awesome guests such as Matt to the show. Lastly, here, before we get on to it, guys, I want to remind you of the free 30-minute phone call that I offer each and every week, where I essentially can jump on the phone with you and talk about everything and anything your heart desires about real estate investing. And it doesn't matter whether you're brand new or a seasoned pro. This is simply my way of giving back and helping you in your business. To schedule that call, go to kevinbupp.com. Two things that I ask of you. Number one, please place some specific notes on what you'd like to chat about during our 30 minutes together. And number two, please show up for the call, okay? I look forward to meeting you. And now, guys, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Matt Lasky. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, managing partner at Equity Velocity Funds, Matt Lasky. Matt, how's it going, buddy?
It's going well. How are you, Kevin?
Doing great, man. Looking forward to having you here. And Matt's a really good friend of mine. We've known each other now for going on a couple of years. And Matt and I have had lots of lengthy discussion amongst a few of our other peers during these last few months as we're going through these challenging times here in the U.S. And so I thought that it would be appropriate to bring Matt on the show, not just to talk about, he and his background, but also to talk about, exactly how they're managing, again, these unique times that we find ourselves in due to the COVID-19 pandemic. And so we're going to have some of that discussion here as well. But Matt, for those folks that aren't familiar with you, that don't know about you, your background, what have you, I'd love to kind of hand it back to you for a few minutes and just have you give us a little bit more about yourself and your background, if you would.
Sure. So been in commercial real estate ever since graduating college in the last recession. Was a finance major, but real estate has always been in kind of the blood and my passion, and had parents who owned a condo downtown Chicago and thought that having $1,500 a month in rent, not doing anything, just show up was a pretty good way to make a living. And here we are about a decade later. Little do I know now, it's not quite that easy, but have cut my teeth in the brokerage side doing investment sales and leasing. And then fast forward to today, now a partner at Equity Velocity Funds. And so we own about $400 or $500 million worth of assets that, depending on where you value some midstream development projects, that's kind of what's accountable for the range. And then Equity, kind of sister company, full service commercial real estate company. So brokerage, asset management, development, construction, and then principals of Equity own deals, but Equity is kind of the service provider to the investment side. So Equity was founded 32 years ago, core competencies in healthcare assets and retail assets from the get-go. So we did our first doctor project 30 years ago and our first retail center 32 years ago. And at this point, we've transacted in 42 states. So we're headquartered in Columbus, Ohio, have offices throughout Ohio, Florida, and Texas, kind of focused on that Midwest to Southeast growth region, but have transacted in 42 states.
Okay, fantastic. Appreciate that, man. And let's back up a little bit and let's talk about the, that foundation, which was you cutting your teeth in the brokerage side of the business. Was that with Equity or was that with another group?
Yeah, so I started my career at Marcus and Millichap. I was that guy making 50 to 75 cold calls a day, hearing a lot of no's, and no would be the most polite thing you would hear on a daily basis. But was formative for the business. Have kind of no fears, just picking up the phone, calling people. Kind of fast forward, my start at Equity was on the brokerage side, doing mainly healthcare tenant rep, but think healthcare in maybe a retail setting. So a lot of urgent care, physical therapy, dentists. Now we're doing a lot of ophthalmology, vet, behavioral health type of stuff. So still co-lead a team with my partner, Patrick Wathen, that does call it 70 brokerage transactions a year nationally. So last year we did like 75 in transactions in 25 states across kind of different healthcare verticals. But it's cool seeing kind of ongoing trends on the tenant side. And I firmly believe understanding tenants' needs on the leased real estate side, whether it's office, retail, industrial, healthcare, helps you be a better investor because you can put yourself in the tenant's shoes and underwrite lease up a lot more accurately than if you've never leased anything.
Yeah, no, great insight there. And as far as your role as managing partner at Equity or Equity Velocity Funds, I mean, what does that look like? What does your day-to-day look like? And what does your overall role entail?
Sure. Well, the days certainly have looked a lot different the last couple months, as you can imagine.
Generally speaking, I guess I'll reframe that question.
Fair. So the way we structured things, we intentionally decided to have kind of the investment thesis person see the asset through to completion. So some firms have acquisition guys or girls hand off the assets to the asset management team, and then they draw a distinction there. We decided that, hey, you're going to eat your own cooking. If you created the pro forma and the asset strategy plan, you should be accountable for it. So it's a hybrid of still spend a lot of my time deal sourcing and underwriting and doing due diligence on acquisitions, then co-leading the kind of portfolio management, asset management piece with some of the team here, but responsible for a lot of the business plan implementation and then seeing the assets through to the end of the life cycle and disposition. Doing a little bit of capital raising. That's the other two partners do the bulk of the capital raising. I do a little bit of that, but call it everything in between, and kind of teasing you earlier, but have done a lot more defense, I guess, rather than offense the last few months, and fielding tenant requests throughout our whole portfolio, working with lenders and tenants to create amicable solutions to get us through out the other side of this.
Yeah, no, I'm excited to have that part of the conversation with you. But I want to ask a question specific to your the structure there, being that you basically you take the torch and you essentially carry it all the way to the end. Would you say that is that a unique structure when comparing your fund or your group to other that are others that are similar size and nature of yours?
Yeah, I'd say so. I think a lot have, call it that handoff from, they've got the acquisitions team and
Yeah.
then the asset management team. And while they might have a pairing and meetings and everybody transition properties in a different way, I'd say usually you don't have that hybrid. We've seen a couple groups do it, and I know at some of the larger institutions, for instance, like named partners at some of the bigger funds will run. Like they'll have the industrial partner at XYZ large private equity shop, and they're kind of responsible for overall business performance and P&L, and so they're a little bit more tied to the asset management, because if in that example the industrial partner needs to produce certain returns, they're more incentivized to see the assets through the end of the life cycle, not just buy it and then shove it over to asset management.
Yeah. Does that create any bandwidth issues within that structure, your current structure? I mean, again,
Yeah.
you're one person, right? I mean, there's only so much
Sure.
that you can do, only so many hours in the day.
Yep. And so there's a team on both sides. There's acquisition people under me and us that report up, analysts. And then on the asset management side, there's a couple other people who do work on the day-to-day, but that's been a growth plan over the last 4 or 5 years, where we've had to build out that staffing. To your point, there are only so many hours in a day, and it has made staffing more challenging as we've looked kind of what's the next evolution of this and how do we grow. It's much easier to find somebody with an asset management skill set, or much easier to find someone with an acquisition skill set, but it's been more of a challenge to find someone who has experience doing both, especially if you're recruiting from larger institutions. It's much more regimented. You're either an acquisitions person, an asset management person, a dispositions person in some cases, but not that exposed necessarily to all three. So it's been great personally to see all sides of the business like that. But to your point, it does create bandwidth issues.
Yeah. I bet. Well, before we start recording here, we're just kind of joking around, in a serious way about just, the many changes that we've seen over the past couple of months. And you and I have had many conversations here, month by month, as far as, what's going on in your business, what's going on in our world. And, it doesn't feel real. It's a very strange time, to say the least. You're up in Ohio, things that you're seeing are very different than what we're seeing here in Florida, right? And I think that that varies state to state, right? Every state's handling a little differently than the next. And then you got places like Portland, Oregon. That's a whole nother world right now, right? So there's just a lot going on in this country. And, but as it relates to real estate, even, we know that in the front side of this, there were certain sectors that took the brunt immediately, hospitality being one of the major ones, right? Like they absolutely are getting crushed. And obviously there's, some of the more tourism driven markets here in the Southeast that are probably at least seeing some type of occupancy gains. But then there's other parts of the country that still aren't, right? They're still suffering greatly. We've got retail, which is one of the big things I want to talk about, right? You're a retail guy. You guys aren't in the hospitality space. And so retail is, that topic of discussion I want to have with you here today. And, more geared towards what I like to call the retail apocalypse. And this has been playing out for many, many years. This isn't something that was triggered by the pandemic, by COVID. It's been playing out for many, many years now. It's been the slow dying death of the, what we know as the retail structure, what we know as malls, what we know as shopping centers, what have you. But now it's been kind of doused with jet fuel, as it relates to the pandemic. And you got store closures, you got, lessened demand for leases, what have you. And then you've got, I looked at a list before we jumped on this call of which companies have filed for bankruptcy, in 2020. The list was actually really long. So I just took some of the bigger, more known names off that list. Neiman Marcus being one of them, JCPenney, Brooks Brothers, GNC, J. Crew, Pier 1. I mean, those are they're major retailers. They've got hundreds of locations across the country. But then to pair, the BKs, the ones that are actually going out of business or maybe on the cusp of going out of business. Then you got the ones that are in business but haven't paid their rent, right? So there's another side of the equation.
Sure.
Folks like Cheesecake Factory and Foot Locker. I think H&M was on that list, the Gap. And again, the list was really, really long. But these are major retailers. They're not paying the rent, which ultimately the landlord suffers that instance. The ones that are filing BK or going out of business, the landlord still suffers in that instance. And so the question I have for you, this is a really targeted question, and it's, is COVID-19 the final nail in the coffin as it relates to American malls or American retail? What are your thoughts?
All right. Big
That's
question.
That's a lot to dissect there. There's a lot going on, but this is going to be a conversation I'd like to have here over the next few minutes if we could.
Sure. Yeah, absolutely. So I'd say, from our perspective, and by way of background, call it 8 or 9 years ago, our investment thesis, we coined the term the Amazon test, and most of the retail we've been buying was service-oriented retail. So think restaurants, fitness, things that were experiential that you couldn't do online. Mm-hmm. If you go back through that list of the retailers you just mentioned, a lot of e-commerce disruption in their business, right? Like GNC, you can buy supplements cheaper online. Pier 1, you got Overstock.com or Wayfair. I mean, very comparable, lower cost, deliverable type things online. So, I would say we've intentionally downsized our portfolio, call it in the 80s and 90s when the company was growing. We did a lot of Walmart and Walmart B space type stuff. And now it's like close infill service-oriented retail, which up until 4 months ago was a great place to be. Mm-hmm. With that said, I think my general sense is that COVID has sped up the disruption and maybe shined a spotlight on efficacy. So I think the class A, really well-located malls will be fine. What I think COVID's going to do is destroy that like county seat town B or C mall that is in, had 2 or 3 or 2 to 4 anchors. So one of the big issues is like the anchor death spiral, right? So when the mall prototype got developed, they had 2 to 4 big box anchors of, call it 50 to 150,000 square feet, of which Sears and JCPenney's were almost always one. Now they're out. In a lot of cases, not only are they out, but other tenants had clauses tied to them. So your anchor goes out, and then tenants have co-tenancy clauses and can void their lease or possibly get out of their lease because of the anchor going out. It can create a death spiral, but it's a really stark contrast because there's multiple nice malls and, call it, growing markets where JCPenney or Sears went out, and the landlord is an institution usually at that point, call it a REIT for the most part, and they're redeveloping it and increasing the NOI that they got because Sears or JCPenney is in at, call it, a few bucks a foot, and they're going to demall it or put up apartments or bring in an office user or build a walkable restaurant strip or small shop space and get 20 to 40 bucks a foot. So there's extra cost and time and effort that go into it, but it's been a weird net positive for a lot of the A malls. And we're talking, top sales per square foot malls, but every large MSA has 1 to 2 malls where those tenants went out and the landlord is probably net winning. But that's in stark contrast to smaller towns and B and C malls where if those guys go out, you start to struggle. And what we've usually seen is 1 or 2 plays from the big landlords. One we call an inversion, where you kind of take the box and flip it on its inside out. So we've seen like Whole Foods and TJ Maxx and Trader Joe's move into the mall or a portion of the mall, or an AMC theater. And so basically taking the inside of the mall and starting to invert it outside as those anchors go. We've seen a scrape it and build something walkable and experiential. So one of the buzzwords we hear thrown around all the time is experiential retail, where you're walking and it's like a faux cityscape or city street, and you've got small shop retail on either side with some entertainment or restaurant component. We're seeing a couple more, and this is interesting on the front edge, like field house concepts, for lack of a better term. So big, call it sports entertainment centers going in to drive traffic because they host these big venues and events and bring hundreds of thousands of people a year. And so we're seeing a couple mall owners look at that as almost a loss leader. They're like, hey, if we can break even on this, but it brings hundreds of thousands of people a year, our other tenants are going to do well. Like, this is good for the long-term vision of our mall and a complementary use. And if you think about, you take your kids to a basketball tournament and they play 4 games over the course of 10 hours and you have a family, you've got downtime. It's, you might go walk into the mall. You're going to go eat and stuff. You're going to have to sleep there. So a lot of these malls are becoming more and more big mixed use, right? So you're going to have a hotel component, you're going to have an office component on top of your traditional dining and retail. And then the other thing is just converting the alternative uses. So adding the office or the apartments, kind of the live, work, play, one shop destination is what we're seeing at a lot of the A malls. Now the malls in tertiary markets, we haven't seen be able to execute that unless it's on rare occasion. So a lot of those county seat malls that were smaller, no one's willing to pay what it costs to make sense of that redevelopment out there. So
no, that's great insight. I want to back up. I want to talk about the A class. Obviously, we're speaking on the premise that this is pre-COVID, right? Pre-COVID, like the different readaptations of the space that were there, the J.C. Penney's of the world, the Sears, things of that nature, repurposing those spaces, bringing new life into a store, a location of that mall that was dying. How does that, I know you don't have a crystal ball, so the question isn't necessarily like, how does that look moving forward per se, the ones that are already existing, but how does that look for some of those A-class malls that might not have, had some of their, or I guess A-class located malls that didn't have some of those big boxes readapt, or they haven't gotten that far with their business plan yet. Now we're amidst this coronavirus. I mean, I would guess that, you're more in tune with, the different larger retail developers out there. Are you seeing that a lot of folks are kind of hitting the pause button for this point in time, just waiting to see what happens? Or, how does this realistically play out here, at least for the remainder of the year with retail developers, that is?
Sure. So I think on the retail side, it is harder to get stuff done. And a lot of the companies you mentioned, or a lot of the retail bankruptcies and failures, have been fueled by private equity investment and maybe over leverage on the operating company level. And so there is heavy private equity involvement on the OpCo side of retailers. And they're largely, I think they're a little hurry up and wait and see what happens type of thing. So they're not, very few groups that we're speaking with are still continuing their growth plans, at this time. And to your point, it is a little regionally different. But one of our biggest learnings as the landlord is owning stuff in Ohio, Texas, Florida, and Michigan the last few months has been a different set of rules in every area. So I think some of this is a little regionally dependent, where you see some more bullishness in a Texas or a Florida relative to a Michigan or up in New York or Connecticut type of thing. We're seeing some groups actually. This is a timely conversation. Was out with a friend who runs big box leasing at a mall REIT, and they're moving forward on a couple projects, but it's one, they're doing one of those field house deals, and they've done knock it down and build a hotel or apartments. So if there's a residential or a change in use component, we're seeing some of these guys go through with it to try to be better positioned to attract retailers coming out the back end. But if their vision is, call it, convert the box to a Whole Foods, or convert the box to, or not J.C. Penney, but Ulta, TJ Maxx type of thing, which we've seen, those are slowing down, where it's retail to different retail that seems to, hit the brakes a little bit. But if it's big box to alternative use for the center, we're seeing them try to largely press through, because they have faith that multifamily demand will come back, or it's already pre-leased office type of thing.
Yeah. I saw a mall, not to really change gears, but I think it was in Texas, maybe it's here in Florida, but basically use some of the the extra parking lot space and literally build a drive-in movie theater, which I thought was actually a pretty good repurpose of that space, whether it's temporary or permanent, what have you. But I mean, I miss driving movie theaters. It's a pretty cool concept, right? If that actually
That's
comes
right.
back, I think that'd be really neat and a good revenue generating component. Um, how about the changes, like the legal changes of the lease structure? I read an article a couple of weeks back that, the traditional structure, whether it be 3, 5, 7, 10 years, what have you, where it's a flat rate that the tenant pays the landlord with, increases tied to CPI, what have you, on an annual basis, that potentially evolving and kind of sharing the risk down the middle to where there's some type of revenue share structure component
Sure.
in there. Have you heard conversations revolving around that? And if so, where do you think that has a place in this new world that we're moving into?
Yeah. So we have now, I'd say, call it, a lot of stuff got built in the 80s and 90s with a percentage rent clause where they were paying low fixed rent and then sharing a percentage of upside rent. And a lot of the retailers didn't like it because, they thought they were giving away too much rent as a percentage of sales. And, it incentivized the landlord to run a really high end mall. I think, yeah. And then the pendulum swung back to, okay, just fixed rent. And now I think we're swinging back a little bit the other way. I think the answer will lie a little bit in the middle, but it's going to be, that's a tough financing putt, right? Because instead of going to a lender and saying, hey, here's our income stream, and the lender really just underwriting credit and sales at the store, now they're going to have to underwrite a profit sharing, right? And we as a landlord, when a tenant comes with a certain huge TI ask, or on some of our smaller retail, which, isn't comparable in scale to this, but it is a little bit of a conversation of, hey, I'm not investing in your business for the returns I'm getting. I'm investing in the real estate. Like, you need to take some business risk here. I can see that happening somewhat, but I think in the best of the best malls have enough demand where landlords will largely say, go pound sand, like we'll find somebody else. I think you'll have to get more creative either for anchors, right? I could see that happening for a tenant that is a huge block of square footage and really brings a new element or it factor. They might be able to pull that off. Or at a lesser, call it like a B quality mall in maybe a good area, but not a great area where demand's not beating down the door for, call it a 70,000 square foot box. But I think it's decent in theory, but it's a challenge, and the devil's in the details a little bit. And I think there's risk on the operator side too, whereby depending on, if you're going to force landlords to take operational risk, you're seeing like Simon Malls do it. They bought a couple retailers. I mean, at some point, if you're going to say, hey, take a lot of this operational risk with me, they could, if they're maybe a little devious, put you in, see how your business goes, and then run a business just like yours after not renewing your lease. And so you have to be careful when you blend business models, right? It's like, hey, are you a retailer? Or are you a landlord? Or you're both? And the landlords, the savvy ones are going to have the capital and more knowledge probably than the retailer. So if you push them too hard, and we see this kind of every time the cycle turns, someone feels like they're not in a good spot. And one time, at the end of the cycle, the tenants don't like how the landlords treat them, and then the cycle rapidly turns and the landlords don't like how the tenants treat them. But I think it's a thing where you have to be careful, because there's hidden embedded risk in like the second and third order effect there that, it might sound good to a retailer today, but it might be penny wise and pound foolish in the long run, depending on how it's structured.
Yeah, that's interesting. I didn't know that. So in my mind, this was a new structure, not not something like a new concept on an old idea, right? That had been in place back in the 80s and early 90s, right, from what you said. So very interesting to know. And speaking of Simon Group, so have they actually played out the model to where they essentially had shared revenues and ultimately started a concept of their own, similar to one of their prior tenants?
Not quite. So okay. The percentage rent structure was common in a whole host of retail for a couple of decades. But Simon has, and I'd have to look it up, and I'm drawing a mental blank, but they've they've bought one or two retailers out of bankruptcy. So a couple of the big mall tenants themselves, and in partnership, they bought the actual company who happened to be a big tenant in their malls.
Got it. So what would a retail opportunity need to look like for you guys today in order to gain your interest? Again, speaking to like today at this time that we find ourselves in, again, knowing that most of your emphasis, over these last months or even year have been on the medical office space. What would a retail space need to look like, or a retail opportunity need to look like in order to really garner your interest and for you guys to take a serious look at it?
Sure. So we're still, pretty bullish on what we would call service-oriented neighborhood retail. So if we could go buy your strip center with, call it, a pizza shop, a nail salon, and fitness, maybe not as bullish on today, but a decent fitness operator or like a froyo shop, and we're buying the asset in a strong suburb of a secondary market. So think like a nice Columbus suburb or a nice Tampa suburb where there's development all around it, and we're in at 60 or 70% of what it would cost to go build that down the street. That's a bet we still like, and we kind of liken the proxy to a lot of those are decisions where the retailer's making the decision at the dinner table, not the boardroom table, is a saying we frequently have, and it's your mom and pop small business, like small medium businesses in America, and that's a bet we're willing to take. With kind of the floor we would put under that is you can't build anything cheaper than it, and if we have to convert the retail to general office or medical office, if it's in a good area close to good people who are employed, we think it'll sort itself off in the long term. We might have to get a little creative in the short term, depending on how bad things get. But if we have that margin of safety where it's substantial discount to what it would cost to build, and then rents are, in line or ideally a little bit below where we perceive market, we would take that kind of bet on the American entrepreneur.
Got it. No, that's great feedback. And at this point in time, have you seen any fallout as a result of this, the pandemic putting downward pressure on whether it be the medical office space, which actually is probably thriving, and or the retail sector? Has any opportunities come your way that have been repriced due to, these last couple of months?
We've seen more and more, call it revised pricing, where somebody comes out and we're like, wow, that's pretty aggressive, like just hard pass right away. And then, a month and a half later, it comes back and the cap rate's 100 basis points higher. But I would say largely there's still a bid-ask spread, and we're not seeing a lot transact. Whereas, using guesstimate numbers, sellers like, hey, my deal in March would have been a 6.5 cap. And, buyers more like, well, maybe I'll pay you an 8, and, that type of stuff's not getting done. We're not seeing as much new retail development, but our development team's working on a couple where it's the development version to what I mentioned we're interested in, where it's, almost just irreplaceable land in really high demographic areas, and completely service-oriented retail of, call it 15 to 20,000 square feet. So all, 2 to 4,000 square foot users. But largely, no, we're not seeing a ton. I think a lot of that is driven by financing. We've looked at a couple retail deals and talked to some of our lenders, and that conversation is much different than on the healthcare side. So we call it the sub-institutional retail game, which is where we tend to play. Most of our retail projects are $2 or $3 million to $10 million. So we're not really competing with REITs. We're seeing almost no appetite, I would say, on the lending standpoint for that type of retail, even though, the cap rates going in are a lot more attractive, and have much better debt service coverage than medical. The perceived risk in retail is a lot higher from the lending standpoint, which creates kind of, a slowness of transaction volume. And so that'll, I think, ultimately translate to pricing. But the flip side is too, most of the people we know got 2 to 3 months of forbearance on their loans starting in March, or starting in April or May. right? So that forbearance on loan payments is going to roll off here starting next month or the month after. Most of those guys pass that forbearance through to their tenants saying, hey, there were different shades, but normally the conversation was, hey, don't pay rent for this, just pay your operating expenses, maybe show me your sales or extend your lease, try to get something out of it. But point being, tenants are going to have to start paying rent again for the most part, call it next month.
Yeah.
And so I think we're still in the early innings of what actually happened with COVID. And you talked about it. Hotels got decimated right away. So did retail, because that's sales made on demand. There's no accounts receivable. They just get paid, right? It's you go to the restaurant, you eat, you pay, they get paid. Whereas like in healthcare, our other side, you have a 90 to 120 day AR cycle where if you think about insurance billing, you go get a procedure done and they don't actually see the revenue for, call it 90 to 120 days. And so that cash crunch is just about to start for the healthcare users, call it right about now.
Yeah. So really to sum that up, these last 4 months or so have not been a real barometer of the real pain that ultimately will be felt by a good number of property owners and, many different sectors, retail, medical office, regular office, even, I know we've had this conversation, Matt, on a few other phone calls, is just even the multifamily space, and we're in the mobile home park space, right? Like our collections have been phenomenal. I mean, not perfect, but really strong these last couple of months. I mean, literally ever since April, March, everyone was losing sleep, going into April, wondering if people were going to pay or not. Very quickly realized that the stimulus package, a lot of our out of work residents are making more than that of when they were employed, right? And so I know that the latest proposal was just released yesterday, and I think if I recall, they're going to lower it to $200 a month. Has not been passed yet, but ultimately that at some point in time, whether it's 3 months from now or 6 months from now, probably post-election, but at some point in time that will go away, and we'll be left with, hopefully not left with double-digit unemployment rates, but who knows? It will be higher unemployment than what it was going into this. We can agree on that, right? And what does that world look like at that point in time? I think that's everyone's concerns. And so I guess the last question I would ask is, what are you guys doing specifically, you and your team doing to prepare and position yourself for these next 12, 18, 24 months? And from a standpoint of preparing for potential opportunities that might roll your way, not necessarily, managing the assets you have, because there could be some pain there, but obviously when pain happens, there's also opportunity that comes out the other side. And so what are you guys doing, you and your team?
So we've ramped up initiative to maybe like everyone has, but we're able to fill a unique niche that will go a little smaller. Still looking at retail, and a lot of the conversations have been similar, kind of from the banker standpoint to what you just said, where they were like, look, no one is technically in default yet. It's kind of like we hit the pause button for a month, because right, I mean, going to be probably loan sometime in the future. So ramping up bank relationships, and then also we're probably in the middle of looking at more than we ever have sale leaseback structured finance plays, where we've got some relationships in that industry of people who are actively acquiring businesses, and the real estate comes with them, and we're willing to do a sale leaseback there and can move quickly, and that kind of guarantee of execution in these times. We think in some of the situations we're looking at, you can get advantage pricing, because these people just want to own the business, not the real estate, and you've got a little bit of a time pressure to close and move quickly. But if we can be nimble and come alongside them and be a good partner, what they pay on a yield basis on their real estate is not the primary concern. The primary concern is getting the transaction executed seamlessly and on time. And so they're willing to pay a little bit for our execution capabilities, and knowing that we would do it programmatically. So we're looking at a couple of vehicles there. and we like it because you're getting, call it 15-year net leases. We're underwriting the credit. They need, in all these instances, they need the real estate to operate. So it's not like a office building. It might be a medical office building of a physician group, but we're looking at a couple more niche industries where it's some sort of auto service business, and they monetize that location, so they need the location type of thing. And we've seen more of those come our way. I think some of that might be because of with the capital markets being all over the place. Some of the more likely typical buyers have maybe stepped back or have other legacy issues that they're dealing with. But between distressed debt and then sale leasebacks, that's where, in addition to, we're still doing our bread and butter medical office building purchasing, but those are kind of the two opportunistic things we're starting to pursue.
That's exciting. Have you guys executed on any of those sales leasebacks yet? I know that you've talked about a few opportunities you were looking at in the past couple of months.
Yeah, we're not. We're still in second or third round negotiation of LOIs on a couple of them. We've done it in the past, so it's something we did 2 last year and a few the year before. But these are a little more scale. So the couple we've done have been, call it $2 to $5 million one-offs. These are both, one of the portfolios would be north of 10 million, and a couple properties. So a little more scale, but that's good for us because you have some fixed costs in a transaction. And if we can just do it once and roll some of those fixed costs over more dollars and have, one lease for 4 properties instead of one lease for 1 property, everyone wins.
Yeah, no, that's fantastic. And what's a debt like on those sale leasebacks? I mean, what type of debt's available?
So that's the other interesting kind of play for us, or why we went toward it. We're getting lower leverage, call it low 4s or lower type debt on it, and low leverage to us is, call it 50 to 60% LTV, and we're talking 15-year leases, 7 to 10-year bank terms fixed for low 4s or high 3s. So the spread on that versus going in cap rates can be attractive. That, I guess part of the thesis on this isn't just that people need capital, but it's also that you could lock in 7 to 10 years of fixed interest while your rent grows over time. So that spread only gets more attractive from a yield standpoint. So it's as much a capital markets environment and function of where interest rates are as people also needing to monetize real estate.
Yeah, well, that's exciting, but looking forward to hear about the first deal you guys take down. So,
well, we still got some time.
Yeah. Well, Matt, this has been a lot of fun, man. I'm real excited. It's about time we actually had you on here. We've been talking about this for like the last year. So excited that I finally got you here, got you off the golf course. No,
that's right.
Yeah.
All it took was a global pandemic. So
exactly.
Here we are.
You shared a lot of great information today, and I really appreciate that. But what I'd like to ask you, if you just had one final golden nugget of advice or wisdom that you could leave with our listeners here today that might inspire and motivate them as they progress in their own real estate investing career, what would that one last golden nugget be?
Sure. So my golden nugget would definitely be get comfortable and learn to sell. And a great book I read about this was To Sell is Human by Daniel Pink. And coming out of school, finance school, everyone talks about being an analyst. And, at the end of the day, the analysts, if they're really good, morph into some sort of salespeople, whether you're an iBanker and you're selling companies, or you're a real estate guy raising capital or originating deals, you're selling something, whether it's yourself, your company, your reputation. And I think that gets lost a lot in that, people think sales and they think like used car salesmen, and you have to buy this, and it doesn't. It's financial sales are complex, and really what it is you're trying to solve a problem or provide a solution for both parties. And the quicker people can get comfortable originating opportunity, which is ultimately some sort of sale, then I think your career will take off.
Yeah. I always like to say, like the who are the best problem solvers make the most money. I mean, it's just it's the truth. So fantastic, man. This has been a lot of fun. But hey, for those that want to learn more about you and what you got going on, what's the best place to reach you?
Sure. So you could email me at M as in Matt Lasky, Lasky at equity.net. Also been actively trying to increase my Twitter presence here. So it's Matt Lasky on Twitter, which has been fun. And I riff about real estate and go off on tangents on occasion. So either of those two places.
Awesome. Good deal, buddy. Well, thanks again for joining me, man. It's been a lot of fun having you.
Yeah, absolutely.
Guys, that's all we have for this week's show. And so until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.